Let's get started.
Okay.
What I'd like you to do is, introduce yourself, give a bit of your background, your company, anything you feel, the audience should know, and then we'll just go right into it.
Sure. So my name's Abner Figueroa. I'm the managing principal of Boro MultiFamily. So essentially, I'm a local owner operator who focuses on acquiring and developing multifamily properties for middle market renters in New York City. So I stay out of the luxury market, and I'm usually focused on emerging neighborhoods where there's an opportunity to develop a property, and there's usually a typical value add component to it. My background is I spent 20 plus years on Wall Street on the structured finance side, doing mortgage securitization, so real estate related. And my family owned a portfolio in East Harlem, which is how my initial touch point into this side of the business on the multifamily side. And I got involved because my dad was getting older and he wasn't doing a great job running the properties, to be honest with you. And that was about 6 years ago. And so I dove right in, started to learn the business, and the properties that I do own are rent stabilized for those who are familiar with that. So I had to learn the lay of the land, the laws, what's allowed, all the reporting requirements. So it was quite an education.
So, I'll probably jump around just because, it's kind of what I like to do, but can you define, since you're talking about, the five boroughs, right? What's a middle market? What would you define as a middle market tenant, in this area? What's your parameters for that?
So that's a great question. So, one of the things that's unique to New York City is when you invest in other parts of the country, non-gateway cities, typically you have garden style apartments where you have 200, 300 units, be two-floor townhouses where they're all in one very large development. New York City and the five boroughs does not have that. And that's usually referred to as workforce housing. So workforce housing in New York City are 5-floor walk-ups.
Okay.
That can be anything from 6 units to 50 units, which is where most people live. Mm-hmm. So traditionally, the middle market renter is the young professional who's either starting a new job or is early in their career and likes the advantages of living and working in New York City. So that's how I define the middle market renter. Another interesting component, which is also unique to gateway cities like New York City, is the income levels are obviously higher here than they are in other parts of the country.
Right. So
it's probably someone who makes between $65,000 and $150,000, which is a lot of money in most parts of the country. But here, it's the middle market. So it's not a $5,000 a month, one bedroom. It's a $2,500 a month, one bedroom. And it's people like my son who just started their job. I need a place to live. People who are moving from a studio apartment to a one-bedroom apartment. So there's an evolution to how they sort of progress through that. But the middle market is the largest part of the rental population in New York City and the boroughs.
Right. Okay. And it's interesting how that really is. It's all relative because, when you talk about $2,500 a month rent as being middle market,
It's a little shocking, right?
It depends on where you are. I've dealt with, secondary or tertiary markets around the country, and you start talking about $2,500, $3,000 a month. That's probably, I can't speak 100% from experience, but that's almost more on the luxury side. Or you can get a big house for that with land, in certain parts of the country. But again, it's good to understand that. So, I'm glad you started off with, you mentioned a couple of things. You mentioned middle market, you mentioned value add, because one of the things that I like to focus on is investor objectives. So, when I talk to students or just when I lecture or guest lecture in different areas, I often see that investor objectives are overlooked or glossed over, but it's such a critical component in terms of knowing what you're chasing.
Correct.
You know,
Absolutely.
and defining, you know, defining your, you know, in your communications with people in the industry, you know, in terms of defining what those are, but also knowing what you're chasing, so you're not casting such a wide net that you're pretty much all over the place.
Right. It's hard to focus when you're casting too wide of a net. I agree with
Right.
that.
So, you know, so with that as your objectives, one of the things I'd like to focus on is, you know, how you vet deals, you know, your preliminary underwriting, your preliminary, just, you know, something comes across your desk. And if you want to spend any time about how you like to have something come across your desk, more than happy to hear that. And then, you know, how you evaluate it to see if it's actually meeting your objectives and if you want to pursue it.
Sure, sure. I guess maybe a good place to start is with how do deals come across my desk is probably a pretty good way to start. So in New York City, like many gateway cities, and really probably throughout the country, no matter where you are, there's a brokerage community that sources deals. And I have found through the years that you really need to depend on them as a way to source deals, despite your interest in sourcing off-market deals, which we can talk about a little bit. They're basically a commission sales force that's working for free until they close a deal. And they're making phone calls all day long. So as someone who's always interested in managing their bandwidth and focusing on the highest value sort of activities for myself as an owner operator, I depend on them and I try to establish relationships, and they make the phone calls. And what usually happens is I've spoken to them. They know my criteria, value add, number of units, sizes, neighborhoods that I like to invest in. And they send me emails, they call me, and then we talk about the deal. So I usually receive a setup which has some nice pictures of the property, some marketing blurb about why it's a great property, and the most important part are the financials.
Mm-hmm.
Rent roll, operating expenses, taxes, and the like, which gives you an initial look at, okay, what's possible. And it also defines whether they're rent stabilized or free market, right? So when they're rent stabilized, which we spoke about briefly before, there are a lot of rules and regulations, from how much you can increase the rent, which is not driven by you, but by the city and the state, and how you have to report and manage relationships with your tenants, from the leasing to lease renewal process, and even signs you have to post in your building, right, to be respectful and responsible. And on the free market side, you basically don't have those requirements. Right. Okay. So I'll look at the deal and I'll start by looking at the financials and saying, okay, what's the opportunity here, or what's the story? So I have a suite of investors that I speak to that I have built a relationship over time, and they've told me, this is what I like, this is what I don't like, and everyone has a little bit of a different way of looking at the world. Some want to turn it around and sell something in 3 to 5 years. Others have a longer hold period. So those are some of the initial criteria that I look at when I'm looking at these setups. And then I have a conversation with the broker and say, okay, what's the story? Because there's always a story.
Mm-hmm. Right.
Are they a motivated seller? Are they in some sort of trouble? Are they long-term ownership? You know, what's motivating them to sell? And then I figure out, is there a value add component? And value add is, can I do something that's going to cause me or allow me to increase the revenue that's coming in? Mm-hmm. Right? Like they taught us in school, cash flow is king.
Right.
Right? Yep. I can't tell you, if I had a nickel for every time a broker told me, oh, it's in New York City, don't worry, it only goes up. Right. You know, I'd be retired by now. Mm-hmm. You know, cash flow matters. So that's really where I start. It's all about the preliminary indication of where is cash flow and where may I be able to take it given my strategy.
Right. And, you know, for your value add, is there certain things you look for? Is it ability to, you know, renovate apartments? Is it broader, you know, capital projects? And I realize that might vary from rent stabilized versus free market, but is there a value add that you try to hone in on that's within your expertise, let's say?
Absolutely. So initially, I was very focused on rent stabilized units because that was really what the value add play that was available to investors in the New York City market.
Hmm.
And so what would happen traditionally is you have a 20 unit building that's rent stabilized. As apartments would become vacant, you were able to renovate the apartments and then increase the rent by a percentage of what you spent. So
Hmm.
basically, 2.5% of what you spent, you were able to increase the monthly rent.
Okay.
So that was the traditional, for more than a decade, value add play that many people were chasing.
Hmm.
And what you wind up seeing is the arbitrage goes away. People start paying more than they should. They start giving away their upside, even though they're the ones taking on the risk
Hmm.
from a capital expenditure and more importantly, from an execution point of view.
Right.
So the markets got tighter and tighter. And then in June of 2019, what we had already seen coming, the state and the city, they changed the rent laws. So they essentially got rid of the value add play and were not allowing you to increase the rent sufficiently to compensate any investor for capital expenditures to renovate and increase the rent. So it really has caused a little bit of a panic in the New York City market because that was really the really the highest part of the volume of activity in the New York City market. So volumes in 2019 really fell dramatically as a result.
Right.
And people were trying to figure out, what do I do now? So as we move forward to today, value add takes on a different component in New York City because you can't execute that strategy on rent stabilized units because that's not available to you anymore. They
Right.
essentially capped it at $10,000 and about $80 maximum increase, no matter what you spent renovating the apartment.
Okay.
So essentially it's zero, right?
Right.
Because
Right.
anyone who's renovated in New York City or any gateway city knows that $10,000 does not get you
Not
much.
gonna get you much, right?
So what has happened now is I have switched my focus to free market units. There's been long-term ownership.
Hmm. Okay.
And there's quite a bit of that in New York City, where you have families who represent really the largest share of ownership. It's not very institutionalized, it's very fragmented, which presents opportunities
Right.
to people who hustle to try to find these deals. They own 2 buildings, 3 buildings, they've owned it for literally 40 years,
Hmm.
and their cost basis is zero, and they just don't want to manage them anymore. And there could be in very good locations, like on the Upper East Side, for example.
Hmm.
And there's an opportunity to go in there. They're very good cash flowing. They're free market units.
Right.
And you can spend some money renovating it, and there's upside on the rent. So that's sort of my new approach to value add on existing properties.
Right.
A second thing that I do is look at vacant buildings. And I think many people who don't know the New York City market are a little surprised that there are vacant buildings in New York City, but
Right.
quite frankly, they're everywhere, even in neighborhoods that you would be surprised. And it could be for a host of reasons. Someone went bankrupt, they didn't want to invest money in the property to refurbish it. There were a lot of violations. The city took it over. So that presents an opportunity to take over a building, completely renovate it, and also have a really great value add component to it as well.
Gotcha. Okay. And are we'll get into COVID a little bit. I don't want to make this whole conversation about COVID, even though we probably could. But um, but I know that New York City, when they changed the law in 19, it did create a lot of panic, or just confusion, let's say, somewhere between, confusion and panic. When you're looking at properties now, I mean, how are you underwriting, even if it's free market, but just additional changes that may be coming down the line, you know, additional legislative changes? How does that factor into either your risk evaluation, your pricing, or anything along those lines?
Well, it's interesting because when I was looking at value add opportunities and I underwrite a deal, whether it's rent stabilized or free market,
Hmm.
I value it based on current cash flow.
Okay.
For some reason, other investors were valuing them based upon the possibility or the potential given the value add.
Right.
And that causes you to give away too much of your potential upside
Mm-hmm.
with the execution risk, as I mentioned before. So what I'm seeing today as a result of COVID is everyone's getting the bright idea once again that, you know what, I'm going to value things based upon current cash flow.
Mm-hmm.
So that has been a very big change in the marketplace. And the repricing that started to happen after a 10-year bull market in New York City and the changes in rent laws has been significantly accelerated as a result of COVID.
Okay.
The transaction volume has dropped dramatically, and dramatically at more than 50%.
Okay.
So price discovery, as you can imagine, is very difficult in that sort of environment.
Right.
So there's a lot of discussion around education. There's a lot of mispricing on deals that usually I would say it's not worth anywhere near that. I don't have the bandwidth, but today I'm having to say I have to invest the time on deals that I think are worth it to aid the price discovery, to try to bring the bid offer spread between buyers and sellers closer to the middle, because it's still fairly wide today.
Right. Right. So let's stick with COVID for a moment. And I want to get a little bit into more of the next step in the due diligence process. But, if you're chasing an opportunity now, let's say, if you're looking at something now, how do you factor in, especially since you're on the 5 boroughs, right? Your focus is on the 5 boroughs. How do you factor in the impact of COVID? Just in terms of looking forward, I know you don't have a crystal ball. I'm assuming you believe in New York's future if it's priced right, right?
Right, absolutely.
With that qualifier. But what type of assumptions are you making? Do you even feel comfortable evaluating when you're saying current cash flow, since the impact of COVID has only been around for 5 or 6 months? Are you discounting it a little further just in case? How does that factor into, without having the crystal ball, your risk assessment?
Well, the first thing that happens is the rent roll. A lot of times when people underwrite these deals, they make assumptions, and I hate to be pointing the finger, but I've seen so many cautionary tales that I try to make sure that I learn from them, even though it's unfortunately at someone else's expense. I sort of keep a list of those and remind myself to be careful and to stick to my underwriting where I think I can create value, and creating margins of safety around underwriting, which you probably speak to on a regular basis,
right,
regardless of the asset that you're investing in. And so on the rent roll side, rents don't grow as quickly as people think, I guess is the bottom line.
Right.
Rents don't grow at 5%, 10%, 7% a year. They just don't.
Right.
For someone who's an owner operator like myself, I have the real life experience of renters will eat a $50 rent increase, no problem. They'll take a 75. Once you start approaching $100,
right,
no matter what they're paying, there's just a perception and a pain point where they're just, I'm not going to eat that, right? So in today's market, you want to retain tenants, so you have to be very sensitive to that. So to give you a specific example, excuse me, I'm looking at a 3-building portfolio in the east side of Manhattan, long-term ownership, needs renovation. It's about 80% free market.
Okay.
It needs cosmetic renovations. Great cash flow because the locations are fantastic. But what do you do about the rents, as you mentioned? So what I've done is I push out the rent increases 24 months.
Okay. Gotcha.
Even in the case where I know that I can renovate an apartment within the first year, I took a 24-month approach to scaling it up to where I think I could get the rents based upon prior history.
Okay.
Because it's going to take a couple of years for the New York City market to really settle in and settle down.
Right.
And I know we'll get back to those points, but people have to feel comfortable coming back in. to the marketplace. So to me, that's been the biggest driver.
Right.
A second is being a little bit more realistic about the cost of renovations,
Mm-hmm.
because things are getting a little bit more expensive in regards to materials,
Right.
and also finding talented people who are still in the market.
Right. Okay.
So, that drives your cost. But really, the rent roll is the most important thing. You've
Right.
got to be honest with yourself, about there is a limit to how much a person will pay for a studio apartment, regardless of the location.
Right. Even if it
Right.
seems insane to other people, but
Exactly. So, if 10 years from now you're saying that studio apartment is going to be $5,000, you probably should recheck your underwriting, because they're not going to pay even 10 years from now, they won't pay. So I think that's one of the biggest changes that I've seen in underwriting from other people,
okay.
and the sort of re-education process.
Right. Right. So let's say I'd like to dig a bit more into full-on due diligence. Let's say it meets your investment criteria, you pencil it out, you like it. Um, you know, you at least get, and feel free to take a jump back on this because I think it's important. If you're talking to investors, if you get their appetite, it meets their criteria during the preliminary due diligence. I'd love to know, to the extent you want to share, at what point do you lock them in, or do you focus on getting them at least lined up and interested, and then you jump into due diligence? So that type of, because it can vary the way people work with their investors. But then I really want to get into the nuts and bolts of when you're doing due diligence. What you focus on, um, what you're really checking to make sure that your initial underwriting is correct, what risks you may see, and just really how you end up getting from that preliminary underwriting to your final underwriting, and decide to proceed.
Sure.
So,
No, that's a great question. And I think when I speak to different investors, and other colleagues in this marketplace, one of my favorite sayings is, it's easy to buy.
mm-hmm.
It's difficult to execute on a strategy,
Right.
right? So anyone who has some relationships or has capital on their own can buy a building. That's an easy thing to do.
Right.
It's really about sticking to your criteria on how you underwrite. And for underwriting, some of the initial things that I like to do is, first and foremost, I always visit the property.
Mm-hmm.
The physical structure tells you a lot about the property,
Mm-hmm.
how it's being maintained, how the common areas look, what the hallways look like, what kind of boiler they have. Is it oil or is it gas based?
Right.
And so I always go and do that. And it's sort of funny. I can't tell you how many times a broker's like, so what do you think it's worth? And I haven't even visited the property. And I have to take a deep breath and say, listen, I'll get a better sense of that and how much I may have to spend on CapEx once we tour the property.
Right.
A second thing that I focus very heavily on is operating expenses.
Mm-hmm.
You get a setup from the broker, and it's made up. You're lucky if they give you the accurate tax number for the property.
Mm-hmm.
But beyond that, whatever they're spending on fuel and other expenses is wrong. And it's sort of what I've learned through actual experience is that the fuel cost and the cost of water in New York City, besides after property taxes, are the largest driver of expenses in any building.
Okay.
And oil, you'd be surprised how many people still use oil as an example.
Right.
So that's often an opportunity, a value add opportunity for me.
Okay.
I've undergone an oil to gas conversion and have saved dramatic amounts of money.
Right.
In one of my buildings, a 10,000 square foot building, I converted from number 2 oil to gas 5 years ago.
Mm-hmm.
I was averaging $35,000+ a year in oil.
Right.
After the conversion, the last 4 years, I've averaged $7,500 a year.
Wow.
Better quality heat,
Mm-hmm.
better temperature control, and that's pure profit. So that's one of the things that I always look for in my initial due diligence. Is there an opportunity for value add there?
Right.
And how efficient are they running that?
Mm-hmm.
The next thing is if there's a rent stabilized component
Mm-hmm.
where they made them free market apartments through the old destabilization. So what you used to be able to do is once you renovated the apartments and the next rent was above a certain threshold, which the last threshold was around $2,700,
Mm-hmm.
you could destabilize the apartment. You fill out some forms with the city,
Mm-hmm.
and it becomes a free market apartment. So if they're telling me it's a free market apartment, I confirm, do you have the paperwork? I want to see the paperwork. When did you destabilize? And there's a lot of sort of chicanery that goes on with that, where they tell you, hey, it's destabilized. And you're like, well, if you destabilized it in 2014 and the threshold was $2,500, you're only charging $2,250 for that one bedroom. Why are you calling it free market, as an example? And it's fairly common, but it's this sort of basic blocking and tackling that you need to do, certainly on the first cut of due diligence, that really brings out whether or not you want to continue to move forward and spend the time running cash flows and getting quotes on repairs and renovations and so forth.
Yeah.
And assuming we sort of get past that,
Mm-hmm.
and it makes sense, I have a law firm that I hire to really go to the Department of Buildings, DHCR rent rolls, and really check all the rent stabilized, that the paperwork's done. But that's an expenditure for when we go into contract. That's not something that I do before contract because there's an expense to that.
Right.
And like you and I have spoken in the past, I kiss a lot of frogs, so I can't spend that money on every single deal
frog
that I
kissing. Gotcha. Right. But that was actually a question I was going to ask because it's such a specialty and it's nuanced. And I'm glad you brought it up and I agree 100%. Once you get past a certain threshold of comfort, like you're going to contract or, that you do bring in a law firm to really kind of dig into that, because I can see if something was misfiled or not filed, or you just believed, that something was free market, that can significantly impact your value if it's not.
Absolutely,
right.
Absolutely. And not only does it impact value, there's a ton of liability. Mm-hmm. So the way the rules are written, the look back could be unlimited.
Right.
And you'll have.
And that was just extended in 2019, right? Because I know there used to be a shorter look back. There was still a look back, but now it's
basically open-ended to a certain degree, and the liability can crush the economics of any deal. So you're absolutely right about that.
Okay. All right. So that's, one of the things that you were talking about there with operating expenses, and I appreciate that this is different maybe than, one of the things I like to discuss on the commercial side, right? So, I've done more office and retail transactions than I have residential. Mm-hmm. So obviously the rent roll itself is critical, but the lease structure also impacts the way you underwrite a property. So for example, if it was, a gross lease structure, which is like what, residential leases are, well, they pay their rent, right?
Right.
It's savings in operating expenses really are just additional profit. When you're underwriting a commercial lease where it's triple net or modified gross, if you're able to see some efficiencies where you can save expenses, that doesn't always directly impact your pocket as landlord immediately. Right. Because it's basically a reduction in rent or a discount to the tenant. Now that's great from a value add standpoint, maybe from a tenant retention standpoint, maybe you can increase rents later on. But I think that's something that it's worth pointing out the differences in terms of residential, and that is just some value add opportunity for you. So I mean, along that line, like you said before, where you're finding some value is things that have been held by a family for whatever, 30, 40 years, right? Do you find that, when you look at the historical expenses there, are they, And I'm sure the answer could be mixed, where sometimes there's just a lot of deferred maintenance that you're going to have to play catch up on. Or on the flip side, that they've just been, operating with the same service contract, for 39 of those 40 years. And it goes up 3% each year. And you look at it and you say, wow, there's a boatload of value here. All right. So,
yeah. Well, what I would say is, from my point of view, one of the biggest value adds that I bring is the property management aspect.
mm-hmm,
More often than not, and it's sort of is a great opportunity for someone like myself to get in there.
mm-hmm,
They're a little bit mismanaged. I don't want to be too harsh, but it's long-term ownership. They're sort of milking the cow for a
mm-hmm,
while.
right.
They keep things clean. It's fairly well maintained, but it's dated. And so you really want to optimize your rent roll, and you want to attract a certain sort of renter because you want to charge a certain amount of money for a one-bedroom unit.
Mm-hmm.
It has to have stainless steel appliances in it. The bathroom has to, be renovated so it doesn't look like it's 1965, right? Which is sort of a common theme throughout the boroughs,
Right.
And it's completely functional. They have the toilets are the old high school toilets. You know what I mean?
Yeah.
Not like a regular residential toilet that you have in your own home.
Yeah.
You live in, in a multifamily house or in a single family home, I should say.
Mm-hmm.
So, those are sort of the opportunities there. But for me, that excites me because that means I can add value.
Mm-hmm.
Right. So I always look for that. And it's really not the exception, but the rule is what I find, particularly in New York City, for these sort of longer owned properties where
Mm-hmm.
they just get tired. And especially if there was a rent stabilized component, there's a lot of work.
Right.
You got to get your hands dirty, and people get tired of doing the work, and it presents opportunities for people like myself to invest.
Gotcha. Right. So, another thing I want to ask is, again, striking the difference between commercial and residential is, if I'm looking at a commercial property, part of it is evaluating the tenancy. Now, you're dealing with longer term leases for the most part in commercial.
Correct.
So if I'm buying a building, it could be multi-tenant or even triple net. Buying triple net, you're really underwriting the tenant. But if you're buying a commercial building, tenant has 5 years left on the lease, you might evaluate that tenant's creditworthiness or something along those lines, but you're looking at longer term leases. Residential, by its nature, is a shorter term lease structure. So
Right.
how does creditworthiness or demographics or anything along those lines, or just even employment in the area, like, do you focus on that? How do you underwrite that from a risk standpoint?
I think that's a great question. And I think this is one of the places where, unfortunately, there is a little bit of a weakness
Mm-hmm.
with a lot of owners. You have to have particular criteria for who you want to let into the building.
Mm-hmm.
And that doesn't mean it's not discriminatory,
Right.
it's credit based.
Mm-hmm.
So I want a 700 or better FICO. You have to make 40 times the gross rent.
Okay.
And you have to have some reserves.
Mm-hmm.
And the debt load has to be manageable. And unfortunately, sometimes you have people who literally have $250,000 worth of student loan debt.
Yeah.
They're making $60,000 a year, and they can't afford a $2,000 a month apartment.
Right.
Right. And you look at what they're paying for their student loans, and it's currently deferred, but it's going to start payments, and you can just see how it could end poorly, particularly with rent stabilized apartments, given that it's very tenant friendly, and I'm being generous with that. It's extremely tenant friendly.
And you're probably still being generous.
And I, I'm very happy during the pandemic. I'm getting 100% payment from my tenants because I'd like to think that I was very cautious.
Mm-hmm.
And I build and develop relationships with them. When things started to close down, I reached out to everyone, called everyone, make sure they were okay, to see how they were doing work related.
Mm-hmm.
And it all worked out. And I like to think they appreciated it. And, when I speak to people, I always say, remember, they're human beings living in the apartments.
Right. Yeah.
So be aware of that. Don't ever forget that. And they're my customers. So, it's an important part of the underwriting. And, you have to have specific credit criteria for who you let into the building.
But also I think you just hit, something important in terms of your approach to management, because you're right. There are human beings living in those apartments. It's a lot different when you're just looking at the general rent roll or the income stream. But I think you also, by reaching out to them, they realize there's a human being on the other side,
Right.
that's still maintaining the building, and it just makes it a bit more real. And I think that connection is important, because it's easy to have a faceless landlord or a faceless property management, and you only deal with them when there's trouble.
Right.
So I think that that's an important part of it's an operating business, real estate. And I like to point that out. It's, whether it's commercial or residential, you're dealing with people that are, living and breathing and using your space, and they need to be able to function.
Right.
So having that connection with them, I think, is a critical part of it. It makes it more real.
Absolutely. Listen, I think that's one of the main factors of dealing in any operating business. You have to be flexible. You have to be able to bend with the times or with the situation, whether it's, I've extended leases for a couple of months and gone month to month to allow them to find a new place. I allowed someone to break the lease once I was able to rent their unit. So, and even on the retail side, so I have some mixed use properties.
Right.
One of my tenants, which was a quick serve restaurant, they obviously ran into trouble.
Right.
And we were trying, they got behind a couple of months, and I had to negotiate with them, and I gave them a break on the rent. And we negotiated. I said to them, listen, he owed me 2 months worth of rent. I said, I'll forgive the 2 months worth of rent if you pay me on time through the end of the year.
Right.
And guess what? That was back in May, and through this month, they paid on time every single month because they had the incentive, and everyone's happy. And listen, it's long term, they're going to be successful there, but I think that's sort of an indication of sort of the unique things you're having to do in this environment.
Right. No, and I agree. And I'm more focused on retail right now, but a part of that was, do I want to work with my tenants and give them some opportunity to be successful, so that once this is resolved, or whatever, I hate to use the word new normal, but whatever it ends up ultimately being, that I actually have an occupied space with a paying tenant? Or do I want to be, overly strict with them right now and end up just losing the tenant? Part of it's just, compromising and working together so that you're not dealing with extra large vacancy or unnecessary vacancy down the line. So it's just that.
No, I agree. It's I have an empty storefront right now. I had a Sprint store in the location, but as many people know, they just merged with T-Mobile. And as luck would have it, there's a T-Mobile store right next door to the former Sprint store. So they sort of hashed it out, and Sprint forced them to close the store.
Okay.
They were a good tenant, and now so I'm looking for a different tenant for that space. And you've got to be prepared for the long haul of, number one, you got to put the right tenant in there.
Right.
And, it's expensive to put in a new tenant. I'm sure you're aware of that. You have to hire a broker, you have to pay them a fee. There's rent concessions, maybe a little bit of a build out depending where you are and what you're doing. And you could not make money quite literally for a couple of years while they get settled and they get started in a business. And that's even more important today. So, it's a very patient process on the commercial retail side. I'm not always a huge fan of it. It's very difficult to make money, especially for, my space is 2,000 square feet. So I'm not getting, Nordstrom's isn't going into the space, right? I could attract some national retailers there, but it's in this environment, it's a little bit challenging. And I always talk to people who are interested in retail and let them know, hey, one of the things I learned is you go through all the trouble of negotiating a lease and paying the lawyers, and in the end, if they don't make money, they leave the space, and there's very little you can do.
Yeah. No, and that's, there's other aspects of it. Maybe we won't get into it here, but earlier on in my career, I was involved on the more residential side. And it certainly has its own headaches from a property management standpoint. you know, there's part of me that would rather, deal with commercial tenants on some of, but listen, I guess everybody has their pain points in terms of, you know, the types of phone calls you get and what you have to deal with.
Right.
So we're coming up on time, and I want to be respectful of your time. So let's talk about, exit strategies, right? So you've gone through, um, you like the property, you did your proper due diligence, you've purchased the property, and I'd like to talk about exit strategies really from two standpoints. One is as your investment objective, how understanding that it can change, obviously, but when you're buying the property, are you already aware of generally what your exit strategy would be? And number two is, just in general, do you have certain criteria that, maybe a property is no longer meeting your objectives and it's time to sell? Like, do you go through a, you know, hold, sell, refi type analysis on your assets?
I definitely do. And I think there's a couple of things, a couple of important issues that should be mentioned in that. So first of all, people are sort of reacclimating to the new investment environment and what's an appropriate return for different levels of risk.
Mm-hmm.
Let's face it, the 10-year is below 1%. So are you supposed to be making private equity returns on a hard asset like real estate?
Mm-hmm.
I'd like to think that that's probably a little bit too aggressive, like making 25%
Right.
IRR on a stabilized property. That's probably not the right place to start. So that's number one. I think number two, investment hold periods are different for different investors.
Right.
So depending who I'm talking to, I'll look at a 5-year and a 10-year
Mm-hmm.
investment horizon.
Okay.
And for someone like myself, I'm a big believer in New York City. While many of the strengths of New York City are considered weaknesses today, they will return to being strengths again.
Mm-hmm.
The level of talent that's available as a workforce, entertainment options, close to the beach. I mean, all the things that were positives will return to being positive. So
Right.
For me, I am always a seller of, hey, what we'd like to do is let's look at a 10-year horizon and then a refi in a year 5 or so, 5 to 7,
Mm-hmm.
where we can take out a substantial amount of equity and delever our investment while still owning the property and increasing our cash on cash returns, which is a win-win for everybody.
Right.
Now, as someone who's modeled many deals like yourself, we're making some assumptions.
Sure.
Right? But we're trying to illustrate what's possible in a sort of conservative manner.
Mm-hmm.
And in many cases, if you're buying in at the right price, which for me is the number one criteria,
Right.
the refi is possible, and taking out equity off the table at some point in the future significantly delevers you and reduces your risks substantially while still allowing you to own the property.
Right. All right. And I think I'm glad you mentioned that because, again, barring the what's probably exaggerated claims about New York's future right now, New York and other kind of gateway cities, lend themselves to being solid long-term holds. It's like you said early on, you don't necessarily want to go with just a general broker theme. Oh, it's New York, it's going to go up forever.
Right.
But, there is a, long-term performance of this market. It's not, a tertiary market that might be really dependent on, one or two industries or something along those lines. There is a long-term aspect of it. So I like, and I'll probably revisit this conversation, with the exit strategies, because there's multiple ways to have exit strategies, like the refi and to delever, as opposed to just selling, especially if it's a quality asset and you bought it right. Those are key things. So, like I said, I'm more focused on office and retail. From the residential standpoint, is there anything that, and it's fine if the answer is no, but if there's, anything you felt I've missed or didn't ask, or if you were, explaining your strategy to somebody who's, not necessarily residential focused, but is maybe looking to diversify? Is there anything you would point out from either residential underwriting, management, or anything along the whole strategy?
I mean, I think a couple of things. And as someone as yourself as well have gone through many cycles,
Mm-hmm.
maybe fortunately or unfortunately, we have a little bit of experience with the different movements in pricing of different assets.
Right.
And I think one of the risks that people face is stick to your knitting.
Mm-hmm.
You have a criteria, an underwriting standard, stick to it. Don't feel that you have to transact to be in the game, because in my humble experience, it doesn't always end well when you're transacting just to be
Mm-hmm.
doing transactions to be in the game. And I can give you a very quick specific example. I was looking at a beautiful property in the Yorkville section of Manhattan, the Upper East Side, 20 units. Someone had bought it 3 years ago, and it was a rent stabilized building, but the value add strategy was still available to them.
Okay.
They renovated and created 60% of the units, 65% of the units were free market in 3 years. Tremendous execution. Even less than that, because the rent laws changed last year.
Right.
I saw this deal 2 months ago.
Okay.
So they did it in less than 3 years. So amazing execution, great strategy. They were trying to sell the property for $22.5 million.
Mm-hmm.
Great. So I look at it. I already knew, it's probably too expensive. Let's take a look at it. But they did a phenomenal job. Great condition property. And when I did a little bit of digging during the due diligence process, I saw the cautionary tale.
Mm-hmm.
They bought it in 2017 for a 2.6 cap rate. And they paid $21 million for it. And they were trying to sell it for 22. Okay.
Mm-hmm.
So already, they lost money because they renovated 65% of the building.
Yeah. Wow.
Right. Which is obviously not included in that number. So I go back to them and I say, hey, it's worth $17 million. So this is why, open book.
Mm-hmm.
And to me, that's one of those cautionary tales about you get caught up in the frenzy of transacting in a market that maybe you don't completely understand.
Mm-hmm.
And now, quite frankly, they have no option other than just owning the building and cash flowing it to try to recoup their investment.
Right. That, that's a very important lesson, because, I've had companies, earn my respect because I've seen them not willing to move off of their criteria and their investment. I'm like, okay, you know what? Maybe they're not buying as much now as other people, but they're going to be around longer probably,
Yeah.
or at least, hit their numbers. Because I saw the same thing. And listen, cycles come to an end, right? And sometimes it's like the financial crisis. I mean, I was dealing with some buildings that were trading, probably in the three cap range on the commercial side in, 06, 07. And even if the market didn't change, there's such little margin for error when you're valuing a building that tightly.
Right.
You leave out one expense,
Oh, that's right.
and that can throw you way off, let alone a major market shift. And then you're just underwater no matter what you do, because it's such a tight margin. So yeah, I'm glad you brought that up. I think that's a great example. So, well, I think, now's a good time to wrap it up. I like to try to keep it to an hour or so. Really, thank you for your time.
That's my pleasure.
I think this was a good explanation of running across the residential. Again, I always like to discuss properties from the whole cycle standpoint. And that's why I like to start with objectives to exit, because not everything in the middle is sexy, but, for one reason or another, I've always been drawn to the middle, to the executing the strategy. And that's why, so I'm glad you kind of went into some of those details. So.
Yeah, no, listen, it's my pleasure. Thanks for having me. Listen, the middle is where all the magic happens,
Mm-hmm.
where you have to roll up your sleeves and make things happen. And again, stick to your criteria, know who your investor is, and it's about execution on your strategy. and have something that's easy to explain and understand, right? Anything that you have to take someone up the education curve, it's a harder thing to get people on board with your strategy. You know, it's simple. People pay rent, you hopefully collect rent, you have some operating expenses, and hopefully you make more money than it costs to buy the property, right? Pretty straightforward.
Yeah, that is pretty straight. Almost makes it too simple. Everyone can do it. So,
Absolutely.
yeah. All right. Well, Abner, thanks again. You know, maybe we'll have a follow up once we get settled on COVID and talk about the, you know, the future of New York and where you see investments going. You know, once we you know, get a better understanding of all of this.
Awesome. Yeah, no, thanks again. And I look forward to another conversation. Take care.
Thank you.
All right.